So Brian, you were telling us we're going to talk a little bit about Brian's option position in Microsoft, and you bought a call on Microsoft when it was a while ago, right?
Yeah, it was a few months ago.
It was a few months ago, and you bought an deep out of the money call on Microsoft for about $18, right?
Yeah.
Just $18. That's all it was, folks. And Microsoft has gone up quite a bit. And yesterday you were talking about what do I do, because you've gone from 18 to
200 something.
Yeah, it was like 180 something, 180 yesterday, I think is what, because you had made 10 times your money. Is that right?
Yeah, I think yesterday. Now
Yeah,
it's
yeah.
291.
Okay, so yesterday you wanted to talk about what should I do. I'm thinking about selling it, and you only have one, so you can't sell half of it. You could do a roll up, which is where you sell it and then you buy something else, but we didn't want to do that, so we talked about turning it into a spread. Mm-hmm. And so you bought the 195 call for, was it March or April expiration? For April expiration. So you've got the April 17th expiration, 195 call. And we said, why not just sell something that's further out of the money? And we looked at the 200 strike, the 210, 220, and there were not any more strikes above that. That was as high as the strikes. So this morning you came in and told us that you decided to sell the 200. Mm-hmm. All right, so Microsoft runs up further this morning, and you get a really good price for that 200 call. Mm-hmm. And you recovered, what would you get, 170?
It was 155 for that.
155?
Yeah.
I thought you sold it for more than that.
No, that one, I think that one was...
You sold, it was 155.
155.
Was what you sold it for? Okay.
Yeah.
All right.
It's a lot higher now.
Is it?
Yeah.
Okay. Well, because Microsoft has gone up really good this morning. And so the reason we did that, we talked about doing that, is because you still own the 195 call.
Yeah.
And where's Microsoft right now?
182.
182. So you still own the 195 call, but you sold the 200 call. So if that thing goes up, continues to go up, your 195 call is going to continue to make money. The 200 that you sold is going to make money, but not as rapidly as the 195. So what you've done effectively is you've lowered your delta, because you're long one delta at the 195 and you're short delta at the 200. So the position delta, you now don't get as much bang for your buck if it keeps going. Mm-hmm. But you've locked in. You bought the options for $18. You locked in a profit locked in a sale of 155. Mm-hmm. So what is that? That is 137. So you locked in a profit of $137 on an investment of $18. That's pretty good.
Yeah.
That's really good. So let's think about that. It's like 6 times your money, or eight times your money. What is it? I'm just doing it.
7 divided by 18. Yeah, 7.5 times.
7.5. Okay. 7.5 times your money. Now, how many times?
Scenario.
You do what?
In the worst case scenario.
Well, yeah, that's as bad as it. Folks, that's as bad as it can get. Is seven.
But it can still go up.
And that's the key, and that's the reason why we said think about turning this into a spread, is because if it continues higher, then, and if it goes right up to the 199.99, just right below the strike price, you will make the maximum on that 195 call, and the one you sold will end up at zero. So you're going to hit even more money. I mean, which is really good. So what is that? It's about almost like another $500. So that's just fantastic. And how many times have you traded stock options before?
Not that much.
Not that much?
Until I came here, I didn't start doing
Okay,
that much.
yeah. Well, they're fun, obviously.
Yep.
But they can also be infuriating.
This is the winning one after a lot of losing ones.
Well, you started winning when you started working here.
That's true.
Okay, all right. So, the question I have is, all right, you've got the 137 profit locked in, and if the stock stops going up at 182, the 195 and the 200 will expire worthless. And so then that's as good as it gets. If it keeps going up above 195 but not above 200, so the one you sold is at 200. If it goes there, then what do you have to do?
I just do nothing, right? And they.
Oh, I'm so glad you said that because the answer is totally wrong. No, what happens is that what happens.
Something that would happen.
Yeah, it would happen. Yeah, something's going to happen. There's an automatic exercise provision, and when you signed up to open an options account, they told you to read characteristics and risks of standardized options. It's about a 200-page document. Yeah, well, there's something in there called exercise by exception, and that's the automatic exercise provision. So that if the stock finishes 1 penny above the strike price, just 1 penny, so 195.01, if Microsoft finishes there, you will be automatically assigned 100 shares of Microsoft, and they will debit your account $19,500. Yeah, you're ready for that, right?
Nope.
Okay, all right. So the beautiful thing is it's really easy to fix that. You just sell it before expiration. But when the options market closes on April 17th, you have to be out of that if the stock is above 195 just by a penny. So keep that in the back of your mind.
All right.
Good brokers are going to tell you that you need to sell that. They're going to you're going to get messages like, come on, Brian, sell this. Because here's the problem. Here's the problem for the broker, and this is why they will do everything they can to fix this. Because if you don't come up with the 19.5, they have to, and they don't. They're fine you losing your money. They hate it when you lose their money, so they're not going to let that happen or try not to. So that's one scenario. The next scenario is that's if it's below 195, you don't need to do anything. Above 195, but below 200, that call you own is in the money, but the call you sold is out of the money. So you've got to do something. If it finishes above 200, what happens? You guys have been here for 20 years. Yeah.
I guess do I have to actually sell the 195 still and buy the...
Well, all right, so let's go through a couple of scenarios. If it's 210, so it's like way above the strike price, and you haven't done anything at this point, what do you, all right, guys?
The exercise by exception rule applies to both of those options.
Yes, so if you don't own the stock, if you sold a call, they have the right to buy. Right, so that's what the call is. They have the right to buy. You sold it, so you have the obligation to sell. If you don't have the stock, they will issue you a short position in the stock at the strike price of 200. So you're short at 200. But then you're also getting exercised automatically a long position at 195. So you're good. They offset each other, and you make that full maximum amount. So you're safe. So 210, 205, you're safe. What if it's a 200.02?
There's a risk.
Well, you're right.
If it's at that amount, I guess the cost...
If at 3:58 p.m., because it closes at 4, at 3:58 p.m. Eastern Time, the 1 year short is 2 cents in the money. And you know that if it's 1 penny in the money,
It'll
be auto exercise, and you're fine, because they'll issue the short position and they'll issue the long position, and you're clear. But it's only 2 cents in the money, and it's wanting to go back down to 200 even, where that short call will not get exercised, and the long call, it's going to get, unless it drops $5 in the last, and Microsoft has how many billion shares?
Yeah.
And it's not going to, it's probably, unless something crazy happens, which we've seen it, it's probably not going to lose that much
fast.
market cap in the 2 minutes. So you've got where you could get exercised into a long position, almost $20,000 in Microsoft stock, and you might not get exercised in the short position to offset it. So what do you want to do?
Or what happens if that happens? That's one thing.
Well, if it's 200.01, he's golden. If it's 200.02, he's golden. If it's 200, he's exercised on one but not the other.
And then you're stuck with the 195, 100 shares of it. The market's closed on Friday, or it's closed at that time. Then you're holding the stock.
You're holding the stock on the weekend, and then Microsoft comes out and says,
Tanks.
"Oh, by the way, we've got a vulnerability in all of our products. Homeland Security has told everybody to remove Microsoft products from all their computers forever because they can't be trusted, and Microsoft goes to 50, and you just bought $20,000 worth of Microsoft shares, and they're now worth $5,000, and you just took a $15,000 hit on something that you thought had $18 of risk in it, right?
Because of that 2-minute time frame.
Yeah. So you've got to do something, and so this is just obviously Microsoft's not going to, something like that scenario is not going to happen.
A more likely
But-
scenario is they have an accounting issue.
Or a more likely scenario is you'll get exercised at $19.5, and it'll come in Monday morning, and it'll be 19.4 or 19.6 or something like that. But you don't want to take a loss on something where you're only where you've where you've already made 7.5 times your money, and you've got that huge profit in the call you own, and that other one is a penny from expiring worthless. So, which is exactly what you want. You have to do something, right? The prudent thing would be to do something, and the prudent thing would be when it gets to about the last 30 minutes, last 15 minutes of the day, if it's right there, then you sell your call that you own, and you buy back the put, or buy back the call that you sold. And it's simple, but the point is you've got to do something, because if it's 210, don't worry about it. If it's 205, if it's right around the 200, 199, 200 mark, you need to do something. So that's
what I didn't realize there was so much extra after trying to secure that profit that could potentially go wrong.
Yeah, a lot of people.
That's why I asked you to read the book.
Yeah, well, it's not just that.
True.
And there's something that we're going to talk about in our 3 pillars quite a bit. And there are researchers show that people, and this is not mom and pop individual investors. These are the pros, that they spend an extraordinary amount of time making their purchase decisions. It's like, I've got to line everything up to get and then it's like, well, what are you going to use for your sell decision? And they just pull something out of their hat.
Whatever.
Their hat.
Well, so they you better watch out or I'm going to tuck something in. So anyway, it was funny. All right. we have a lot of fun here, and we learn a lot, right? Okay. So, but what happens? The thing that's really fascinating about that is that when you look at what a stock does right after one of these institutional guys buys it, that stock tends to outperform the market. So they actually make good purchase decisions. But what is crazy is that they make really crappy sell decisions because they just shortcut it. And so they don't have a plan of action prior to, it's like, oh, now what do I do? So they spend all this time, and they say, well, I got a 200% profit, I'll just sell it. Well, you know what? You need to put as much thought in the exit as you do in the purchase. Yeah, exactly. Exactly.
Because nobody ever made a dime.
Yeah, because nobody,
Buying an
you remember this lesson, folks. You never made a dime getting into a position. You make your money when you get out. So that's it. Hope you enjoyed this.